Unfortunately, the Eurozone sovereign debt crisis continued to create volatility for global investors in November. News at the start of the month that the Greek Prime Minister was going to hold a referendum on the IMF EU bailout created a new dynamic for the crisis, raising the possibility that a country could leave the monetary union. Although the Greek government voted against holding the referendum and a new technocratic leader was put in place, this news highlighted the fragility of the crisis. Political concerns for the other countries in the Eurozone also eased somewhat as the technocratic Mario Monti was appointed leader of Italy. Spain also elected a new government whose mandate centred on structural reforms and austerity to bring the deficit back to sustainable levels. Despite these changes, peripheral bond markets continue to underperform as the yields on Spanish, Italian and French debt all moved higher. The spread of Italian and Spanish government bond yields over Germany moved out to levels at which Greece, Ireland and Portugal received bailouts from the EU and IMF. However, the current bailout mechanism does not have the capacity to bail out these countries. Fears that France may be downgraded from its AAA rating also increased, putting the AAA rating status of the EFSF bailout fund into doubt. Furthermore, Germany's status as a safe haven was also questioned during the month, particularly as demand for German government bonds waned at its November auction, when only 65% of its issuance was taken up by the market. This sent the German 10-year government bond yield out from 1.8% to 2.27% by the end of the month. In the US, the economic data continued to stabilise, reinforcing economic forecasts of a slow but expansionary economy for 2012. Leading indicators continued to show modest growth for both the manufacturing and non-manufacturing sectors. Data for the labour market also continued to point to job growth, albeit at a much slower pace than would be associated with a normal recovery.